This is Company Breakdowns from Turpentine, a deep dive on a compelling tech company's strengths, TAM, business model, and potential for market domination. I'm your host, Erik Torenberg, and on this season, I'll be joined by the smartest people in tech to record one-hour deep dives on companies like Reddit, Databricks, and more. Today, CJ Gustafson joins me to dissect Rubrik's strategy to IPO.
CJ, welcome to Company Breakdowns. Excited to explore your deep dive on Rubrik. Thanks for joining.
Whenever an S1 drops, I'm looking for friends to hang out with and discuss it. So, Erik, it's a privilege to be here.
Amazing. You found your tribe in us and the audience. For people who don't know about the company, why don't you just briefly describe what the company does, and then let's get into the origin story.
Yeah, so I can try to describe what the company does and maybe their history a bit as well. So I have a interesting point of view because I worked at one of their competitors originally. It was called Veeam. It was a backup and recovery vendor. And you think of kind of this dusty old kind of sector that where boring things occur, but it's actually a major part of the data ecosystem because data proliferates and you want to back it up over time. And so this company, when I was working at Veeam, was kind of the new kid on the block for backup and recovery. Everyone's like, who's this Rubrik? I heard they have Kevin Durant on their cap table. Like, they're cutting edge. And a lot of the backup and recovery stuff was on-prem at the time. It was sold as perpetual license, and it was done through really expensive field sales motion. Some of that is still true about Rubrik today, but basically this really smart guy, Bipul, he leaves a really powerful VC job. He's at Lightspeed to start Rubrik, and he had invested in Nutanix, which was a data storage provider. And that's where he saw the light. And people, if you don't remember Nutanix back like 10 years ago, they were actually the plucky upstart for data storage and management. And so they had a cool way of doing things that was cutting edge, and he wanted to apply that to backup and recovery. And so they start doing this kind of hardware, kind of software, kind of backup recovery thing, which is game changing when you consider, like I said, everyone is this stodgy backup and recovery company. And then they later undergo this transition from the classic perpetual on-prem license model to the cloud-first subscription-based delivery mechanism. And that's like one line in their S1. That's like a 5-year journey. It is extremely painful to undergo that. And they came out on the other side. And not only did they make this monetization shift, which is really hard to do, they also started doing cool cybersecurity stuff along the way, which expands their TAM. So once again, I was kind of competing against them in a sense when they were only doing backup and recovery. I woke up and read this S1 and I was like, holy shit, they're also doing cybersecurity too, and they're really good at it. And so then their last funding round, Microsoft comes around. They write this big check in 2021 as a strategic partner. Pretty cool logo to have on your S1. And that brought their valuation to $4 billion. And so since then, they've developed a product suite that has data protection, data threat and analytics, data security posture, and cyber recovery. But once again, it all just started with data protection.
And say more about what they figured out that these other companies that could have been them didn't quite figure out. Like, what are the forks in the road, and what are the decisions they made that the other companies that you were part of and otherwise didn't?
Yeah, so they did this thing called an appliance, which is a fancy word for like a piece of hardware to store stuff on. So there were these two schools of thought. And by the way, I can't code. I'm not technical. I'm like the finance guy who's doing like the TAM analyses. So this is like me just like trying to explain it. So don't get angry at me. But basically, this appliance thing was a way to do backup and recovery that involves some hardware. And that was kind of frowned upon by a lot of people, but they made it in a much more efficient way than had been done before. Some people looked at it like, oh, you're actually going back in time to do something that we're trying to get away from instead of storing everything in the cloud. But then what they started to do was detect that I have all this data that I'm storing backup and doing backup and recovery to. People are also trying to hack the environments that the data is in. So why don't we expand into cybersecurity? And with like great TAM comes great competition. And so now it's not just like they're competing against the Veeams and the Cohesities of the world. They're also competing against like the Datadogs and Palo Altos, who suspiciously were not named in their S1.
It's amazing that Kevin Durant had this foresight of where the market was going to go.
Yeah, I mean, as if like being 7 feet tall and having a wicked jump shot wasn't enough. Like, he's making way better angel investments than me.
That's pretty incredible. Say more about what surprised you going deep on this S1.
Well, first of all, they named that they had 99 customers over $1 million. I was like, bro, you couldn't have got like one friend to get you over the 100 mark. That was the first thing that surprised me. But the second thing was just how damn expensive their sales force is. Okay. So 42% of their employees are go-to-market employees. And if you look at their P&L, Eric, and you add up G&A and R&D and add them together, that's still smaller than what they're spending on sales and marketing. They spent nearly $250 million last year on sales and marketing, which is really expensive. Now you may look at that and say, yeah, but they're growing over 40%. Like it kind of makes sense. Yes, but when everyone wants you to be more efficient and you need to sell through multi layers of your go-to-market ecosystem, it can rack up some bills. And what I mean by that, just for the benefit of listeners, is they also sell through a channel model. So they have a distie and a reseller for a lot of these big enterprise deals. And so a lot of the customers say they're selling to, I don't know, they're selling to Johnson & Johnson. They don't want to have to make one-on-one relationships with all of their IT vendors, like for security, for backup and recovery, blah, blah, blah. So they go through one point of contact, which is the reseller. And so there, in that sense, Rubrik isn't provisioning their own licenses. It's going through these other two channels, but they also get a rip along the way. So the distie may get 1%, the reseller may get 3%. And then they're also paying the sales force to do it as well. You know, somebody who's making, $300,000 a year, along with their BDR who's making $75,000 a year, and their SE who's making $250,000 a year, and then that person's manager. And so these deals that they're closing are bigger. They are a mid-market enterprise player, but once again, there's a lot of mouths to feed when you add up all the different people around the table who are attaching to that deal. And I'm kind of curious how this evolves over time, because a lot of Silicon Valley sales forces have moved away from this. Like, I kind of look at it as, still like the bourbon and steak dinner travel budget type sales, where you have these people on the road who are very expensive and they're taking people out to dinner. It's just like an older way of doing business that was very popular in like 2005 to maybe 2015. And they kind of still have that Salesforce vibe.
And is that sort of going away, or do you say that as that's kind of like just a relic that is likely to stay, or is that a risk, or how should we interpret that?
I look at it a bit as a risk because it's extremely expensive to pivot away from. And someone could argue, well, how are you going to get into the enterprise with like a PLG deal? And I agree with that. But at the same time, you have to be really careful about your unit economics. So before they were doing these perpetual deals where they knew pretty much the entire amount upfront that they would get, and it's pretty easy math on paper. A recurring revenue stream is much better in the long term, but if you churn and also had that expensive field sales motion, you're kind of screwed, right? So as long as their retention is still strong, that's great. But the other thing I look at, Eric, is they're still losing on paper more than 300 million a year. I think it was like 358 million or something. The bulk of that's sales and marketing. So if I go through and say, how does this get to like sustainable profitability, like within like a stone's throw, my eyes automatically go to the sales and marketing line. But then I say, can I still generate the same amount of sales if I cut away from that? So it's kind of a catch-22 in that sense. And what I get a bit of heartburn about is like, how do I need a lot more revenue. And in that traditional field sales model, it's kind of like a widget. Like I worked at a place where I was building the sales capacity model for this. And it's like, well, for every $2 million in revenue we add for an enterprise rep, we also have to add this person and that person and this person. And so for their model, it's kind of like, how do you make that work to make the revenue run faster than the expenses if it is like a 1-for-1 that you're putting in to try to get to break even?
You mentioned that Rubrik has entered a few different markets. Can you talk about the either the TAM of those markets or just the nature of it? Like, do you think, are there network effects between those markets? Are there risks that they're spread too thin and someone just focusing on one of the markets will do better? Or how should we think about this?
Yeah. So once again, after dominating backup and recovery, they did expand into cybersecurity. And now you're competing against observability and threat detection vendors, which is great, but it's also scary. It's great because it's one of the most resilient budgets out there. Like there's no board discussion where they're like, hey, let's cut the cybersecurity budget. Like that and backup and recovery, actually, they're probably like the two most economically resilient budgets out there. But you're also competing against, like I said, like Datadog, CrowdStrike, Palo Alto, some of these massive cybersecurity juggernauts who sell multiple cybersecurity things. And that's also a big thing with these enterprise deals. It's a lot of CFOs want to try to do a deal with just one vendor or two vendors rather than a bunch of them. And so that could both be good and bad for Rubrik. It could be good in the sense that a CFO says, oh, great, I can buy my backup and recovery stuff. I can have data protection, data management, and I can also do some sort of cybersecurity. Great. But if they're looking at the cybersecurity budget, I'm not technical enough to know if they address everything that you'd want, but I'm guessing that they're still building out new product suites, and because that's the newer part of their model, right? And they said they compete against people who provide cyber, ransomware detection and investigation, security posture management, insider threat detection, data classification, and other data security or data governance technologies. That's like a mouthful, and that's like a lot to compete against. So as cool as it is that they're opening up their TAM, there are some really powerful companies in each one of those, that word salad I just gave you.
Totally. And let's go deeper on their revenue model. You mentioned, subscription revenue, you mentioned maintenance revenue and other. Can you explain the contribution and importance of each of these streams?
Yeah, sure. So their subscription revenue was 538 million. So that's the GAAP revenue for last year. But if you look at like what's the exit value of it, it was almost 800 million. And so they say subscription ARR does not include any maintenance renewal associated with perpetual licenses, which we generally no longer offer. And so what they were doing is they were converting customers who would pay them once for something, get the license in perpetuity, and then every like 3 years they would buy what they call a maintenance contract. And that's just so you get the updates of what they've improved on the software. So it's kind of like a bastardized version, honestly, of subscription, where like you show back up and pay this like reoccurring amount if you do want the updates. But then some customers say, no, I'm good with this, with the old stuff, I'll just keep it. And so they've been porting customers over to this subscription amount. What's risky about that sometimes is that it doesn't like ramp up immediately. A lot of times you have to sell more seats, or if it has a usage construct to it, you have to increase usage over time. So it's not like it does take an investment to get there, but overall it's stickier, it's easier to forecast, it's more reliable, and hopefully less likely to churn. With these big perpetual deals, I remember we would show up to renewal sometimes and we'd all be biting our nails like, are they gonna want to buy the maintenance contract for this? And so as cool as it was to like take down $1 million perpetual deal, you've kind of taken your whole nut, and then you're showing up later hoping that they buy some dessert on top of that. They did have 39 million of maintenance revenue. So 86% was subscription revenue, 6% was maintenance revenue. And the maintenance was, that renewal for like the upgrades over time. And they said maintenance revenue associated with sales of perpetual licenses of our legacy CDM product decreased by 37.5 million or 49% in FY24. That's actually good. You want that to decrease. You want that to die off. And then they have other revenue. Other revenue is sale of perpetual licenses. So I guess they probably still had some governments and major schools knocking on the door. And they're like, we don't do that anymore. And they're like, well, how about 51 million? And they're like, fine, we still do it. And so they took the money for that. And then there's one other thing to call out. So within their subscription revenue, not all of it is cloud. And so now you're probably like, what are you talking about, CJ? So it's small but subtle distinction. Okay. So some of it is still on-prem, but they pay you in a recurring method for it. But on-prem in that sense is it's not in a public cloud. It's not like you're using AWS or Azure or GCP and just paying them a bill every month for it. It's like we are so wary of people hacking us or people taking our data that we built a data center, which is very expensive. And it's actually kind of funny. A lot of companies are actually going back to that right now, which is odd. You wouldn't think, but we built it on-prem and we store it there, but we'll still pay you a subscription amount. So not all of the subscription revenue is cloud, but most of it is.
And do you think, or how long will that remain? At what point will it shift to that?
I think eventually it would all become subscription revenue, but I don't think you'll ever get to a point where it's all cloud revenue. You have like government agencies, you have like super secretive organizations, or even actually it's the old school ones. There are a bunch of like Fortune 500 traded like auto companies out there that like don't trust AWS just because I don't know why, but they've like we don't trust anybody. We don't trust computers really. Just like technologically laggards. I bet there are some people who are laughing at me right now. Like that's not the only reason, but it's hard to get everybody to go over to the cloud and trust them.
So some of Rubrik's numbers are pretty impressive, right? This sort of 133% net dollar retention rate, and the subscription ARR doubling the last 2 years for customers over 100K. Say more about what do you think's contributed to this success, and how should we think about the likelihood of Rubrik sustaining a very exciting growth trajectory?
Yeah, net dollar retention, if you deconstruct it, it can go up if you buy more of the same product in terms of seats or licenses. If you use the product more and increase your usage, if you buy net new products, and then it can go down if you churn or use less of it. And so they've had this embedded growth story because of adding all these products over time. So they started with these backup and recovery customers, and they're like, hey, you want some cybersecurity stuff too? They're like, great, okay. And then they also grew with a lot of customers over time. So they were early to the to certain sectors really ramping up, and I think they placed probably some good bets of who they sold to. I remember when I was at Veeam, they were really good in some like fintech sectors and like just things you wouldn't think about. And so that's kind of placing a bet on different customers over time. I'm interested how much though the net dollar retention rate was kind of artificially propped up with the perpetual licenses, because since they started that shift, it's actually dropped. It used to be around 150%, but this could be me just like throwing stones at something that I shouldn't, because benchmark wise, anything over like 120 is really good. Anything over 130 is awesome. So for me to say like they were at 154%, I think, and came down to 133, I'm kind of like being overly strict, but I do wonder if a lot of that was propped up from the perpetual license sales and maintenance license sales, because it coming down kind of coincides with that.
Yeah, that makes sense.
We'll get back to the conversation in a moment after a word from our sponsors. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave also has a private ad platform? Brave Ads offers first-party targeting, and it's been cookieless since day one, so you can relax while third-party tracking cookies disappear from the web. Today, millions of people turn to ad blockers to avoid being tracked and pestered online. But Brave's new ad model aligns incentives for users and advertisers. Users earn rewards for viewing ads, which they can save, spend, or pass along to their favorite creators. And advertisers score points for respecting user privacy, generating ROI without invasive tracking. So whether it's high-impact announcements on the new tab page or keyword-targeted ads in Brave Search offers diverse, private, future-proof ad formats for all your business goals. Join the future of advertising at brave.com/ads. Mention Turpentine to get 25% off your first campaign. Hey everyone, Erik here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at erikaturpentine.co. That's ERIK at turpentine.co, and let's partner together.
I want to segue to R&D in sort of increasingly competitive markets. How does Rubrik's strategy drive development of new products and features to stay ahead of the curve?
Yeah, well, first of all, I did the Control F, Eric, and they only mentioned artificial intelligence 10 times. So
Right.
I think we all should hats off to Rubrik. Didn't rely on that. Reddit actually used it like a bazillion times, I feel like, and they're a social media site. But I was saying that sales and marketing makes up more than half of their OpEx, right? but R&D is still growing. So what I always look at when I get one of these P&Ls is I look at the percentage of revenue for each category, but then I see if it grew year over year. And so they said research and development increased by 31.5 million or 18% in FY24 as compared to FY23. So what I look at is did it increase? And then what was the growth rate in it compared to my revenue growth rate, just as a proxy. So their subscription revenue grew a little over 40, I think it was 47%, and their R&D grew at 18%. And so about half of that, I look at that as a pretty healthy investment they made. If they were investing like more than 40%, I would be like, oh, holy shit, maybe they don't have it figured out on the product roadmap side, or they're playing catch up. Or they would have to have like a really good theory on like why they're doing it. And then if it was under 10% in single digits, I'd kind of be like, oh, they're just kind of milking this install base. They don't have anything new here. So me not being a technical person, that's how I assess it. Like when I look at a P&L and say, are you investing in R&D? But when they talked about what they were investing in, they said 21.2 million was headcount, right? So you need people to actually code it. I guess GitHub Copilot hasn't replaced everyone yet. And then they said the remainder was attributable to co-location hosting fees, so moving stuff to the cloud, and then other software and subscription services. But it's mostly people.
Yeah. So you said you want it to be over 10%. What is the number of sales and marketing as a percentage that would make you feel much better, or like what do you think would be a realistic target, a good target?
I think over time you want to try to get it to 30% of revenue. I think right now, if I was doing the rough math, it's about 50%, or maybe just a little bit below. But I look at that as kind of a sustainable model. At the end of the day, you kind of want 25% to drop out of the bottom in perpetuity. And so it's like, what do you cut to get there? And if I'm looking at it, it's like 50% on sales and marketing. It's like, am I playing a shell game almost to keep the revenue up by putting widgets in the sales to pump the sales, but I can never get it low enough to actually have sustainable free cash flow margins?
Totally. One of the things you mentioned at the beginning of the piece is that they basically had to go public because of the prep stack, because the revenue. Ideally, you want to raise money when you don't need it to have the most leverage. But of course, companies need money. That's why sometimes they go public too. Talk a little bit about their situation and how you see it more broadly when a company is going public, from a position of strength versus a position of weakness.
Yeah, well, I look at what the pref stack is. This one, I thought it at first was like closer to 1.2 billion. I think some was secondary in there. So let's just round it somewhere between 800 and 1.2. Let's call it $1 billion. They've raised $1 billion. That chunk comes out first. Those people get paid first. So if their last valuation was 4 billion, hypothetically, $1 billion goes back to the investors. Then they split up the remaining 3. What's interesting about this one is they're actually going to IPO at a higher mark than they were at before. So if you remember Reddit, they had to come down. Most of the companies going right now are going to have to come down. These guys raised at 4 billion, which is huge back in the day. From Microsoft was the last one in, but it looks like they'll probably IPO at about 8. But if they were to get acquired by somebody, like I said, for like 4, 5, 6, that's a huge chunk that comes out of the pref stack, and then it gets divvied up. So a lot of employees are probably saying, let's please IPO. A lot of the management, like CEOs and stuff, if they hold common shares, are saying, let's IPO. And that's because upon IPO, the pref stack gets wiped out. Everybody is on the same footing. And then it's not like an unequal economic event. This also has more upside baked into it, where the shares can potentially run and those people can participate in it. And there'll be a 180-day lockup period for those employees on board. That's something to call out, by the way, that everybody thinks that employees are instantly rich, like when they IPO. 180 days is 6 months. Like a lot can change in 6 months. You can the company can literally the share price could go down by a lot in 6 months. So you're not just out of the woods yet.
Totally. And maybe just zooming out a little bit, we started the call by saying that you love reading, S1s. How does this S1 compare quality in terms of when you read this S1 relative to other S1s? Are you like, oh, this is a solid business that really understands the levers, and you're bullish on it, or are you, or not as much? How do you compare it?
So I always read the CEO's statement up front on all of them. This guy, I think, is just like way smarter than me because I didn't understand what he was saying. So I read that and I said, okay, I'm just gonna look at the P&L now. Usually I get pretty hyped up. Like Instacarts I read, I was like, oh yeah, okay, this is cool. This one I was like, I don't really know what this guy's talking about. But I think like this, as my temperature coming out of this one was, if these guys can do well in their IPO with the amount of cash they're burning, there are so many companies just like chomping at the bit to say we're next because they're burning cash, because these guys are burning a shitload of cash, or losing a lot of money. They were technically like within 15 million if you like close your eyes, squint them, and like spin around 3 times to free cash flow positive within like 15 million. But like they're not making money. So like far from a beacon of profitability, but I think they're legit. Like they've done some really hard stuff that most companies fall flat on their face. So like the first hard thing they did was transition from perpetual to subscription, and their growth rate sped up. Like that's nuts. The second hard thing they did was move into a new TAM, not just a new TAM, but like the most competitive, most technologically like hard to build, like tech risk TAM. Like sometimes you move in, and you're like, oh, it's just execution risk. Like moving to DoorDash's TAM, you're like, I just got to deliver stuff better, faster than them. They're like, no, we're gonna move into a TAM where we're gonna create cybersecurity stuff better, and they actually did that. So I think that's like a killer combo. And I think what they sell, like I said, is relatively macro resistant. Like you don't just stop backing up your data no matter how poorly you're doing. And I think the other theme that they got across really well, Eric, and they described it well, is data proliferation. So data is exploding. While they didn't say we're riding the AI wave, they pretty much said we're riding the data wave, right? Like that's not going away anytime soon. What made me feel like a little bit like is like this isn't right down the fairway. It wasn't super easy to understand. Like, are you a data company? Are you a cybersecurity company? Are you a subscription company? What kind of? And so it wasn't like I could fully check all those boxes. But like I think what makes them complex is also what makes them kind of cool. So like factoring in all of that, as long as you still think that like expensive sales reps will be around in 10 years, and you're not that like you're not waiting on the edge of the seat for like dividends or something like that, I do think that this is a really solid company who's accomplished some great things.
And let's sort of summarize or flesh out a little bit further by saying, when you specified the bull case and the bear case for this company, if you were really trying to convince someone why this is going to continue to grow and continue to be a great business, say that case. And then if you were trying to say, hey, maybe not, let's say that case. And you said a little bit, but
yeah. All right. Bull case would be they're in 2 economically resilient categories with incredibly large budgets at the Fortune 500 level. And what they sell is incredibly sticky and hard to rip out. Like you get a cybersecurity vendor in, like you have a better chance of ripping out the office carpet before you take that out. And like the amount of time and effort and expenses it takes to implement some of this stuff, if it works and it's backing up your data, you're not going to take it out. They also have an incredible NPS score. As much as I think NPS scores are total bullshit, like it's 83. That's really good. And it means that customers like them. I also think that they have a really good understanding of where they sit within their competitor set. They went into it with eyes wide open. And I think it's really hard to have this scale 800 million and still be growing north of 40%. All that said, I think it's a solid company. What's the bear case? Let me think. The first thing is losing money is a good way to go out of business. And if you lose money forever, you certainly go out of business. The second thing is Kevin Durant could tear his ACL at any moment again.
Yeah, the Suns might not advance. I mean, it's very risky.
Yeah. And what else? I think just like the ability to continue to innovate. Like doing a lot of things at once makes them valuable, but it like your bandwidth is constrained to a certain extent. No matter how much they raise in this, whether it's $500,000 or $1 billion, how do you continue to do all these things well? Not only execute from like a selling perspective, but also from a technological perspective. Things will continue to change. And it's kind of that idea of jumping S curves of like where you are in the TAM. So I think they saw that data recovery was maybe not growing as fast. It's not known to be like a crazy fast growing, forward thinking market always. And they timed it well with cybersecurity. So I think if you're investing in them for the long term, it's like, well, what's the next TAM that they can jump into? And do they have a right to win in that space? And then the third thing is, are they going to be able to sell it, right? And sell it at a level that is unit economic or contribution margin positive? Because if you need a net new sales rep for every $1 million in revenue in perpetuity, that model gets tough. So at what point do you get more efficiency out of your sales force so you can eventually generate profits? That's the bear case. Mostly Kevin Durant, though.
Well said. How should we think about the valuation and sort of the sort of multiples?
Yeah.
And yeah, how should we evaluate that?
So I would only look at the subscription revenue when you value it. I throw out the other stuff. So like professional services, not counting that. The old maintenance stuff, I know it's going away or it's going to show up in my subscription stuff. So I would take the 788, I think they were at, let's just say 800 million. And then I would forecast what's the next 12 months. So if they're at 800 now and they're going to grow, I don't like doing public math. Let's just say it's like a 30% growth rate. Maybe that ends up being 1.1 or something in the near future. I would take that and I would multiply it by something between 10 and 12. I mean, they deserve it based on the growth rate, in my opinion. And this is where like valuation becomes more art than science, because you're also betting like, will I want to be holding this stock based on the long-term growth profile more than 12 months out? Like we use revenue multiples as a shorthand, especially because a lot of companies are losing money like this company. So you can't use EBITDA or free cash flow multiples, but you're also trying to think like longer term, will this be a good buy then? And so one of the metrics I like to look at is revenue endurance, which is basically the rate of decay of how because it's harder to grow a bigger base of revenue, right? So how long can they take the number and keep it there? So like the growth rate doesn't go from 47 to like 30%. It goes like 47 to 45 to 40, and they stretch it out longer over time. That's the biggest factor of increasing the terminal value of the company. And I mean, it's pretty amazing that they're still growing at this rate. So they would have to, I think, mess something up within the short term to fall.
I can't believe that they were able to shift to subscription, as you said, while also performing even better during the transition and after the transition. How were they able to do it? Does it just speak to an incredible team, or how are they able to do that?
It speaks to how good the product is, because it means people actually used it and ramped up their usage. Because if you port them over one for one, it's going to be less on paper, like because you have to divide it by 12. And hopefully they took all the same services that they were getting before. I mean, what was wrapped into a perpetual license is you're basically doing the back of the envelope math on what's my LTV on a customer. And if you think they're going to stick around for 3 years, you're basically charging them the subscription equivalent of 3 years and 1 year, and then discounting it back based on the time value of money. And so it means that people bought even more of their shit once they went over to the subscription. And that's pretty amazing. Usually it's kind of like, I'm going to monetize this different. Maybe it's actually a chance for me to step off the treadmill if I was just okay with you. So it means they both retain and expanded their customers.
Yeah. Well, speaking of expanding customers, you talk about how most of their customers are in US and Europe. Do they go even more global, or do they continue to focus on those markets, or where's that next growth going to come from?
Every company tries to go into Asia because they have these huge budgets, and every company comes back like looking like Tom Hanks from Castaway, just like it didn't work.
Yeah.
And so they still have single digits in Asia in terms of where their revenue comes from. I remember when I was at Veeam, we were trying to go to Asia, and that was painful, man. And every country has its own culture, its own way of doing business, its own discounting practices, which you forget about. Like in some cultures, they expect like a 80% discount, so you have to change your list price. It's nuts. But I would say like going into Asia geographically would be big. And then it's also where you follow the population growth and if companies are outsourcing the people who use your product. So a lot of people don't realize that like like a US based company may have a ton of people overseas in like India. I mean, even Rubrik has 25% of their employee base in India. And so you're actually selling, sometimes it'll show up as like where the headquarters is when you sell it. Like it was sold like to a US company, but a lot of the licenses are overseas. So I think you have to follow where the workers are that are using it as well.
Yeah. One other side note, say more why you don't think NPS is the right or is overrated, and what's either an alternative or what's the best way to evaluate what your what customers think.
I think like the best way to evaluate is to actually talk to them. But I called Net Promoter Score the Ozempic of metrics. They both offer the illusion of progress, addictive simplicity, a measure and not a long-term solution, diminishing returns, and pure vanity. And so I'm gonna sound like a crazy person. Like I wrote like a manifesto on why I hated NPS. But basically, NPS, there's no actionable insights. It's like, what do I do with this? 83. It's like, all right, high five. It's like, I don't know what to change in my business if I don't like it. The second thing is like you're asking people hypothetical questions. Like, Eric, would you recommend me to a friend? You're like, yeah, sure, CJ. Then you go in the other room. You're like, Avedon, this thing sucks. I'm not recommending this to anybody. It's like, it would be better if I actually had revenue against it. The second thing is timing misalignment. So they always seem to ask you like right after you do something of value, like you made a bank transfer. It's like, would you recommend us to a friend? It's like, yeah, sure. Okay, that went well. And I actually think that NPSs are meant to go down over time. And what do I mean by that? So you expand your ideal customer profile. So you may start with like people in fintech, but then you want to sell to people in manufacturing. First, people in manufacturing probably aren't going to be as hyped about you just because you were selling stuff to somebody that liked you already. And if you look at purely at NPS, it would tell you like this isn't a very good bet you're making. And then a couple other things. I mean, like the feedback is pretty siloed. Like they tell you they would recommend you, or like they score someone who promotes you, a net promoter. Well, what was the context around that? And then a lot of times, this is sneaky, just as a metrics person, a lot of times they'll take and CSAT score, which is different, and they'll call that NPS, which is like a total bait and switch.
Yeah. And we'll link to some of your writing on it. I was disillusioned with NPS a bit when I was at Product Hunt. Our users loved us, and every time we would talk to them or we would do surveys, but we would then track that against their actual usage of the site, and they never use the site. When we tried to chart, because they would use it when they launched, but they'd only launch a couple times a year or something, and they loved their experience on launch day. But they weren't paying us either. When we tried to charge, they wouldn't pay. And we would compare it to things like LinkedIn. When you ask people about LinkedIn, they're like, oh, this product sucks, but they use it 10 times a day and they pay for it. So
yeah.
Yeah, I'd rather be unloved, but have people, using my thing all the time than loved, but not using it. And
totally.
Yeah. Gearing towards closing here, there's been a great overview of your excellent piece, which we'll also link to. Is there anything else on the company that we didn't get to, or that you want to leave us with?
A couple other things just to call out is that like I look at gross margin as the path to leverage, and their subscription gross margin was 82%. It did go down year over year. It was 84 and then went to 82. So I didn't really like that, but anything over 80% is amazing. That is awesome. And it helps you get that 25% to drop out of the bottom, except if you're spending half of it on sales and marketing. The stock-based comp was a lot lighter. If you looked at the package that the people at Reddit were getting along with this IPO, it was astronomical. Like everybody in the C-suite. This one, it was kind of like 3 co-founders. They each have 7%. Cool. And like I think they only had $6 million in stock-based comp charges. So once again, that's a non-cash expense, but it still hits your bank account. But like for having 3,000 employees, I thought it was low. And I just think that like the last valuation they got money at was probably kind of fair at the time. And I'm excited to see a company go out and actually get a higher valuation. It's not going to be like this, lukewarm, like, oh, this is cool, the IPO, but it's actually worth less. So I'm excited more so, Eric, for like what comes next. If these guys can make a splash, I think the floodgates are open, especially if you're someone in and around the cyberspace. And we all know there are about 100 companies who are watching from the horse stalls next door, waiting for them to go.
Well, that'll be hopefully it does, if only so that we have more S1s to discuss on this podcast. CJ, thanks so much for coming on and sharing a deep dive on Rubrik, and look forward to the next one.
Thanks for having me on, man.
And lastly, highly recommend Run the Numbers. Everybody check it out. And Mostly Metrics, must subscribe, must listen. CJ, thanks as always.
You the man, Eric. Catch you later, man.
Thanks for listening to Company Breakdowns. Make sure you're subscribed on Spotify, Apple, or YouTube. Let us know in the comments or reviews what companies you want us to deep dive on next. Company Breakdowns is a show from Turpentine, the network behind Moment of Zen, Turpentine VC, Turpentine Finance, and Request for Startups.